Hi guys. As promised, uh, I'll show some questions and give you some information about the exam, the midterm. This will be a single video for the economics students and also public finance students. There's only one difference in your exams, and that is for economics students, chapter 7 is included because we covered that in the first lecture. So for economics students, you're responsible for chapters 7, 8, 9, and 10. For public finance students, chapter 7 isn't included because we covered that last term. Instead, you'll have an essay question at the end, which is 20 points, I think. Like a classic essay question. So that's the only difference. The rest of what I will talk about applies to both of these departments, okay? Okay. And I wanted to go over your textbook because I know most of you haven't even seen the book or downloaded it or taken a look at it. So because you're responsible for this book, or at least what we have covered from it so far, I'll go over it quickly and solve some questions from the textbook. Okay, so I'll cover the differences at the end, okay? So let's start with chapter 8. This was perfect competition, right? And I advise everyone to just read the chapters, or at least not everything, even though the chapters are short. We have skipped most of it, so which makes your job much easier, right? Just read the parts we have covered. So when I say an essay question, I mean things like, for example, here, perfect competition assumptions, right? There are 3. Firms are price taking, there is product homogeneity, and there should be free entry and exit. So a question could be, what are the 3 basic assumptions of perfect competition? And I ask these 3 things, right, from your textbook. And also I would ask you to just explain these shortly, right? So things like this. We talked about profit maximization conditions, right? Which was marginal revenue equals marginal cost. And in your textbook, you can see how we get it, or where does it come from, right? For example, chapter 8.3 explains these things. Here is the very important condition, and if you read just 1 or 2 pages, it explains to you how we get it, right? I have also explained this graph in the class. So of course I cannot explain everything, right? And like I cannot explain half the term in one lecture, so I'll just go over it and remind you what we have covered, right? I won't ask you to draw graphs for midterm, so you don't have to worry about drawing this graph, right? But it's better if you understand what we do in these graphs, and not all of them, right? There are hundreds of graphs even in a couple of chapters. I have only talked about a handful of them, okay? So such as this one, so you don't have much to focus on. This is also important for perfectly competitive firms when they are profit maximizing. These three things, marginal cost, marginal revenue, and price, are the same, and you might need to remember this for solving some questions. We didn't focus much on the differences between short and long run, but we have covered this graph, right? And in the context of whether the firm should continue production or shut down all operations, right? And quickly, if I remind you, as long as your price is higher than your average variable cost, you should continue production, right? The graph you see is for the perfect case, because price is higher than the average total cost, so you're actually making a positive profit, an economic profit. It could be something like this. Price is actually lower than the average total cost, which means in the end you will make a loss, but your loss would be much smaller compared to much smaller compared to what your loss would be much smaller compared to your loss if you stopped production in the beginning, right? Because your price is higher than the average variable cost, but you should look at, of course, you should look at the difference in here, because that's where your production is. If you don't think about your fixed cost, you are making a profit for each sale, right? So if average variable cost was higher like this, then it means you are making a loss with each sale, so you should immediately stop producing, right? So we have talked about all these. You can read the text to understand it better. And that's basically it for this chapter. Sorry. Let's go to chapter 9. And at the end of do we have a question? Sorry, let me check. Do we have an exercise? Yes. So this one, at the end of chapter 8, there's a question. Let's solve this quickly. And I have already saved it. So maybe do something like this. Okay. For perfectly competitive markets, we have a question like this. It gives us market demand, market supply, firm total cost, and firm marginal cost. Actually, it doesn't have to give us this, right? Because we can take the derivative of the cost function to find the marginal cost. So let's solve this question. It asks us the equilibrium price, equilibrium quantity, output supplied by each firm, and the profit of each firm, right? And lastly, entry and exit, whether there will be entry or exit from this industry. There are some other questions like there's C and D. It asks additional things, but we don't need those. Let's find equilibrium price and quantity, and for that we equate supply and demand. So demand is 100p equals to supply. So becomes 1300. So equilibrium price becomes it's 5, right? Equilibrium price is 5, and you can put it in either demand or supply functions, which will give you, so if you put 5 here, 500, so 6000. These are your equilibrium price and quantity. Now we need the output supplied by each firm. This 6000 is industry supply, right? We need firm supply, and for that, if we knew how many firms there are in this industry, we could just divide the total supply by that, and we would find how much each firm supplies. But we don't know that, so we have to do something else, and that something else is using marginal revenue equals marginal cost. And I also told you, or I just showed you, that when we have a perfect competition, price is also equals to these two. We have marginal cost, marginal revenue or price. We know the marginal, we know the price, which is also equals to marginal revenue. So we can use these information to find small q, which is what each firm supplies. So marginal cost is 2q divided by 200. It is equal to p, which is 5. So 2q equals to 1000, and q is 500. Each firm is producing 500. So how many firms are there if the total supply is 6000? it means there are 12 firms, right? The question doesn't ask us this information, but you can just do it yourself. Lastly, we need the profit. Profit is revenue minus cost, and revenue is price times quantity, right? So we know the price, which is 5, quantity is 500, so this is our revenue. What's the cost? We can use the cost function. So 722 plus quantity is 500 square 200, which is, let me just calculate. It makes 1972, and if you do revenue minus cost, you get, which is your profits. And lastly, question in the B part asks us, will there be entry or exit? You have positive profit. Normally, in perfect competition, profit should be 0, right? Economic profit should be 0. If you have above 0, or if you have a positive profit, it means this industry offers better returns compared to other industries, and that means there will be entry into this industry. If it was 0, we would say there will not be entry, nor will there be exit. But if it was negative, we would say there will be an exit from this industry. So that's how we solve this type of question. Let's get back to the textbook and chapter 9 specifically. This part was about a more detailed look at competitive markets. Specifically, we talked about consumer surplus, producer surplus, what happens when there's a tax or a minimum price, right? This type of stuff. So this graph is important. In perfect competition, this is the price, right? This red line is the price line. We can extend it. The area above the price line and below the demand line, which is this area, is the consumer surplus. The area below the price line and above the supply line, which is this area, it's your producer surplus. We have covered this. We have covered what happens when there is an intervention from the government, for example. If the government says you cannot sell for more than this price, right? So the new price line becomes this red line. And because suppliers are only willing to sell this much, you should look at to the left of this line, right? So the area, let me use a different color. Can I use a different color? Yes. Okay. So the area between the demand line, which is this line, and the price line, which is this red line, becomes this. So this whole area becomes consumer surplus, right? Producer surplus becomes, this was the price line. Producer surplus becomes this area only. So we have talked about this, these things. B and C, we lose these areas, so we call them deadweight loss. So read this part. Make sure you understand what happens to consumer surplus, producer surplus, depending on a condition like this, right? Or you could have a minimum price restriction. We talked about these things. And then we skipped most of, like I have I've done my best to, like, there are many complicated graphs and different details, conditions. I have skipped all of those, so we have skipped all of these. Let me just show you. We have skipped all of these things. Like, there are many more complicated stuff. We have skipped the quotas and tariffs, all of these. So we talked about tax and subsidy. You should read this part of the chapter. Actually, yes, so we have an exercise like this. So let's solve that, which is this one. So let me make this a bit bigger. Okay. So we have a demand and supply functions. Actually, these would be called inverse demand, right? But it doesn't matter. First, let's find equilibrium price and quantity, which is very simple. 10 minus q equals q minus 4, 14 equals 2 q star becomes 7, p star becomes 3. So this is before any government intervention in competitive markets. But in the second part, the government imposes a tax of $1 per unit of, in this case, a widget that is sold. So what's the new equilibrium quantity, and what's the price the consumers pay, and what's the price sellers receive? So here we don't have a single price anymore, right? We differentiate between So let me write the demand and supply functions differently. Let's but okay, it doesn't matter. You can leave Q alone and do it that way, but we can do it like this too. So PB, price buy or price buyer, is 10 minus Q. Price seller is Q minus 4. We don't have a single price anymore, right? So currently we cannot solve these equations because we have 3 unknowns and just 2 equations. We need another 2. We need an equation that gives us the relationship between price and buyer's price and seller's price, and we did it by adding the tax, and the way to do it is just to have a think, because there are 2 cases, right? It's either a tax or a subsidy, and they have 2 different outcomes. So in terms of a tax, you pay a price, but the seller, in the tax-free case, you pay a price and the seller receives the same thing, right? Like the entirety of the price goes to the seller. In case of a tax, you pay something, but the seller only receives a minus tax, right? So you have to understand this logic to create this function, and this is the most important part. In this case, the seller receives less than what you pay, right? So it should be something like this, and you can check this by giving numbers. So let's say if you paid 10 liras, this means the seller only received 9 liras, right? Which satisfies this condition, right? The seller receives less. So you can check by doing something like this, and if you can write this equation correctly, then you'll solve this question without any issues. The other option is to put this tax to the left side, right? And if you do that, of course you'll get a wrong answer, but let's say you did it that way. Just put some numbers, and if it doesn't make sense, then you know you have to reverse where you put the tax, right? Okay, so now we have a relation between price of buyers and price of sellers. So wherever we see price of buyer, we can write this. In this case, price seller plus 1 equals 10 minus Q, and price seller equals Q minus 4. We can have this plus 1 on the other side, so this becomes price seller is equal to 9 minus Q, price seller is equal to Q minus 4. and these are equal to each other, right? So 9 minus q equals q minus 4. 13 is equal to 2q. Q star is equal to 6.5. And if Q star is 6.5, price seller is equal to 2.5, price buyer is equal to 3.5. So we have the new prices and quantities. If we compare, quantity has decreased from 7 to 6.5. So there is less production. Price was 3. Now the buyers pay more and the sellers receive less. The difference of 1 is the tax, right? Which the government gets. We have answered all these questions. Another question could be, how much tax revenue does the government get from this? So from each unit, the government gets 1 liras or dollars. How many units are sold after the change? 6.5 units are sold. Then that means this is the tax revenue, right? 6.5. So this is how we solve this type of question. I won't solve a question for subsidy. The steps are the same. Just what changes is this amount, subsidy amount. It doesn't have to be 1. In that case, you have to put it on the other side, right? But if you understood the logic I tried to explain, then you won't have any issues. And also in your textbook, it explains this logic. There are some additional exercises. You can try to solve these and ask AI to give you the answer. Okay. Lastly, we have covered chapter 10, which is about monopolies. And we have also covered monopsony. With public finance, we haven't covered monopsony, but with economics, we have. It gives you basic information. For example, we have talked about these graphs. You should take a look at them. This example I will solve, but before that, I have explained all these. What happens when monopolist firm produces more, the price changes. You get the price of that extra production, but because the price changes, you lose some money, right? So we have covered why this is important. You should take a look at these. For example, I have skipped all of these. Monopoly power, there's a discussion. We have skipped all of these. In this chapter, what's important is this part also. We have talked about what gives a firm monopoly power, right? There are 3 conditions or determinants. Elasticity of market demand, number of firms, and interaction among firms. Take a look at these. But let's get back to that question, which is this. This is for a monopolist firm. We have a cost function and a price function. This is called, again, inverse demand. If it gave us Q equals to 40 minus P, this would be a demand function. Just the order is different. It's the same thing, right? Let's find the equilibrium or the profit maximizing quantity and the price for this firm. What can we do? We have cost. So we know that marginal revenue equals marginal cost for profit maximization, right? We have a cost function. We can find the revenue and take the derivative of these functions to find margin revenue and margin cost. So easier one is marginal cost. So if you take the derivative of this function, you get 2q, right? For revenue, let's first find the revenue. Revenue is price times q, right? We have the price, so 40 minus q times q, this is the price, is 40q minus q square revenue. So marginal revenue becomes what? 40 minus 2q, right? And if 40 minus 2q equals to 2q, which it is for profit maximization, 40 becomes 4q, q star becomes 10. If q is 10, then price is 30, right? This is basically how you can find profit maximizing price and quantity. Is there anything else? Maybe we can find the profit. So profit is revenue minus cost. Revenue is price times quantity, so 30 times 10, which is 300, minus cost. What is the cost? Cost is 50 plus 10 square. This will be 150. So profit is 150, right? And this is how we can find the profit. Okay. We have skipped all these. We have, so this is the difference between the two departments. For economics students, take a look at these. The main thing is, instead of marginal revenue equals marginal cost, you have marginal expenditure equals marginal value you get. You can take a look at the graphs, not these ones. Monopson power we have skipped. We have skipped all these, and I have solved a question in the class, so I don't remember where I got the question. Maybe I just made up the numbers. You can also check these exercises. If you don't have that question, you can ask your friends, or maybe I might have put it on iBuzem. Check that one too. But that's about it for the midterm preparation. For again, for public finance students, make sure you read the chapters carefully, especially for when there's a list such as conditions for perfect competition, right? Or sources of monopoly power. Those are more important. Also, read the introduction of each chapter. This is true for everyone. Lastly, for economics students, you don't need to read the whole of chapter 7. I mean, if you read it, you will understand it better because it explains economic cost versus accounting cost. It explains the opportunity cost, explains why opportunity cost is equals to economic cost, explains the sunk cost. So it gives you the definitions, right? It gives you, again, these definitions. And then all of these. Just take a look at these, okay? But you should be able to solve there are 2 exercises on iBuzem with their answers. We have solved a question similar to those in the first lecture. So in essence, you should be able to solve that type of question. Like, you should be able to determine what's the sunk cost, how to calculate accounting cost or profit, how to calculate economic cost or profit, right? When I give you a list of costs, you should be able to determine which one's a sunk cost, which ones should be included in the economic costs, and so on. So that's the difference between you and the public finance. And this is all you are responsible for. But I am saying it again. Take a look at the textbook, okay? If you try to just focus on the questions I solved, you might not be able to solve them because you need to understand the logic also, right? Because the numbers will change, maybe the questions will change in what they ask. So read the textbook. We have covered only a small part of these chapters. Essentially, you are responsible for just 3 chapters and only a small part of those 3 chapters. So make sure you read the textbook. I think I even let me check. I think I put the textbook. Did I? Maybe not. Well, in any case, it's in the syllabus and I'm sure you can find it. If not, you should ask your friends. Like, I know for a fact that it is downloadable online, so you shouldn't have any issues finding it. You can check websites such as LibGen or Enos archive. For sure, if you check these websites and put the name of the textbook, you'll be able to find the textbook. Okay. And that's it. If you have any questions about the exam, any further questions, you can send me an email. I was in my room in the office hours today. You can also come next week if you have any questions on Thursdays before noon. Other than that, just send me an email, and I wish you all good luck in the exam. Next week, because it's midterm exam week, we don't have a class. So yeah, see you in the exam. Bye.